Okay, let's dive right into this explainer. Today, we're doing something incredibly practical and highly analytical. We're going to step into the shoes of a sell-side equity analyst and build a rigorous, fully documented discounted cash flow valuation, a DCF, of Group 1 Automotive. And we're doing this using absolutely nothing but their Q1 2026 earnings reports, press releases, and filings. If you've ever wondered exactly how the pros turn a mountain of raw financial data into a precise target share price, well, you're in the right place.
To structure our analysis, we'll be using the Analyst Build framework. We'll start with the business model and segments, move through operational trends, derive free cash flow, figure out our WACC, build a forecast, and finally, calculate that intrinsic value per share. Let's get to it.
Starting off with Section 1, Business Model and Segments. Before we even touch a spreadsheet, we have to ground all of our assumptions in reality. So, how does Group 1 actually make its money? Now, what's really fascinating here is the profound divergence between revenue and actual profit. A casual observer might think a dealership is all about, just selling cars. And sure, vehicle sales do drive a massive top line. But the highly lucrative parts and service segment, making up 47% of gross profit, and finance and insurance at 25%, actually generate over 70% of the company's total gross profit. That is the true economic engine of this business, and it is absolutely essential for our forecast. And they certainly aren't putting all their eggs in one basket. Group 1 operates 257 dealerships, with a new vehicle sales split of 66% in the US and 34% in the UK. They're spread across 35 different automobile brands. By maintaining this transatlantic footprint and huge brand variety, they're effectively spreading out their market risk, which gives us way more confidence in the stability of their future cash flows. Moving right along to Section 2, Operational Trends and Margins. To really understand their profitability engine, we need to isolate the operational drivers that are going to dictate our future cash flow assumptions. Management is definitely not sitting still. They are aggressively leaning out the business. They're executing a massive $50 million cost-cutting program and completely eliminating nearly 700 roles in the US to drive 200 basis points of SG&A leverage. Plus, they're innovating with AI and virtual F&I, which is already running 20% of deals in a third of their stores. Talk about driving productivity gains. So here is the crucial anchor for our entire model. This is a specific quote straight from the CFO, Daniel McHenry, on the Q1 earnings call. He essentially anchors our assumption that SG&A will stabilize in the mid-60s as a percentage of gross profit going forward. When you're building a DCF, finding a direct management target like this is absolute gold for defending your margin forecasts later on.
All right, Section 3, Deriving Free Cash Flow. With the operational reality established, let's step walk the math from reported accounting income all the way down to unlevered free cash flow.
Let's break down how this actually builds. We transparently bridged from $242.6 million in reported operating income, or EBIT. We apply the 23.8% effective tax rate found right in the filings to get our net operating profit after tax. Then, we add back the non-cash depreciation and amortization of $31.1 million and subtract $53 million in capital expenditures. Boom! That establishes our baseline unlevered free cash flow of roughly $163 million for the quarter, prior to any working capital changes.
Now a quick aside here. We have to carefully note the difference between our unlevered calculation of $163 million and the company's reported $95 million adjusted free cash flow. The company's reported figure actually includes financing costs and massive working capital swings, especially around inventory. But for a firm-wide DCF, we evaluate the cash generated strictly by the operations, completely free of any capital structure impacts.
Which perfectly tees up Section 4, WACC and capital structure. To discount these cash flows properly back to today's dollars, we must determine the weighted average cost of capital. And for an auto retailer, that requires a deep look at their specific debt structure.
Group 1 has about $3.14 billion in total debt, but roughly $2.24 billion of that is what's called floor plan debt. Because this type of debt is strictly tied to inventory financing, it literally scales up and down as cars sit on the lot. We make the standard analytical assumption to treat it as an operating liability. Therefore, we strip it entirely out of our structural cost of capital calculations. Now for the equity side. Since the filings don't hand us market risk metrics, we explicitly supplement our model with standard external assumptions using the capital asset pricing model. We're applying a 4.5% risk-free rate, a 5.5% equity risk premium, and a 1.2 beta to reflect the inherent cyclicality of auto retail. Punching that all in yields an 11.1% cost of equity.
Next, we factor in the remaining $902 million of non-floor plan debt, which includes their mortgage and bond debt, at an estimated pre-tax cost of around 5%. We apply our target capital structure weights based on current market values, and we arrive at an estimated enterprise WACC of roughly 9.5%. This right here is the hurdle rate we'll use to discount our future cash flows.
All right, Section 5, Forecast and Terminal Value. Armed with our baseline cash flow and our 9.5% discount rate, we can now construct the explicit forecast window.
Over a 5-year explicit forecast, we're modeling a pretty conservative, gradual revenue scale-up. We start at just 2% for the remainder of 2026, acknowledging some of those current macroeconomic and weather-related pressures noted in Q1. But we scale that up to 4% by 2029 and 2030. That growth is driven primarily by the proven resilience we saw in their high-margin parts and service business, alongside the ongoing realization of their AI and inventory workflow optimizations.
And for the period beyond our 5-year explicit forecast, the terminal value kicks in. We explicitly assume a 2.5% terminal growth rate into perpetuity. Why? Because this serves as a highly sensible standard proxy for long-term GDP growth in the mature automotive sectors of both the US and the UK.
And finally, Section 6, Intrinsic Value per Share. The moment we've been building toward this whole time. We combine all of these calculated elements to derive the ultimate intrinsic value of the equity. By summing the present value of our 5-year explicit cash flows, which is about $850 million, and the massive present value of the terminal value at $4.35 billion, we arrive at an enterprise value of $5.2 billion. We then carefully subtract the $860 million in non-floor plan net debt to find an implied equity value of $4.34 billion. Divide that by the 11.9 million diluted shares currently outstanding, and we get our final number. Based strictly on this fundamental buildup, the filings data, and our stated assumptions, our DCF model yields an intrinsic value of approximately $364.70 per share. What is absolutely fascinating here is that this tracks incredibly closely to the recent market closing price of $356.86 found in the earnings report. The market is pricing this stock almost exactly in line with the underlying fundamental cash flow generation.
But as we wrap up this explainer, I want to leave you with a really critical risk factor to ponder. Management explicitly noted in their presentation that a 100 basis point increase in interest rates decreases their annual earnings per share by about $1.67. So with margins running this tight, how rapidly could shifting macroeconomic winds, like a sustained rate hike, alter this fundamental intrinsic value tomorrow? It just goes to show you, evaluation is really only as good as the macro assumptions beneath it. Think about that. Thanks for joining me on this deep dive into Group 1 Automotive.